Well, NAFTA's actually done a lot of good. And that, in a sense, is the case, not in a sense, is the purpose of today's sessions. Not to be unfair, not to ignore the displacements that occurred to workers that always occur anytime commerce takes place, but to make the positive case, the sound intellectual case, the detailed case for why this trade has been a benefit to the U.S., to Mexico, to the world, and then to think about where it goes from here. A triumph of American statesmanship and a positive move of economic policy for all countries involved.
When you look at Mexico's productivity performance over the past few decades, it's clear that you can see the picture of the nation in that chart. You start on the second half of the 20th century with the rapid growth period of import substitution, the desarrollo estabilizador. Then we see the rapid boom even of the 1970s, the excess boom, if you want. Then the lost decade of the 80s, and after that, the slow turn to growth again. But the big takeaway from this look is that, in essence, the average productivity of Mexican workers today is no higher than it was 30 years ago in real terms. And that really is Mexico's growth challenge. Given that the productivity of workers hasn't grown, most of Mexico's growth has come from expanding the labor pool. So let's look at the three kinds of things that we would expect to see change dramatically in order for Mexico's productivity to accelerate. The first one is clearly the small traditional enterprises need to increase their productivity. We need to reverse the productivity decline. And here, what would it take to do that? And clearly there are many reasons for why small enterprises are small. One of the reasons is that some of them have no other employment options. However, when we looked at it at the sector level, there were two factors that really mattered. The first one was the fact that the economic incentive of staying small and informal continues to be high. And the second is that capital constraints are very binding for these companies to grow to become mid-tier and potentially even larger companies. The second factor clearly is the fact that capital is constrained particularly for the mid-tier as well as the small and medium-sized enterprises. I don't think we have ever seen an economy where small and medium-sized businesses don't complain or don't consider that capital is constrained. It is the nature of the beast. But Mexico truly is a case where that story is different. So in order for Mexico to raise its productivity, clearly the large part of the small enterprises, there needs to be a change in their productivity performance. We need to see more of the mid-tier growth companies and have capital play a bigger role in creating a dynamic mid-tier company. And the third component is that we clearly need the large, modern, local and global multinationals and local companies to continue to do what they're doing, increase their productivity and push their frontier. These companies have maintained their employment share at roughly 20% of employment, which means they have been growing at that 2% point a year. So they have been growing, but not fast enough to gain their share. I think it's important for them to continue to gain share. And what it would take is to continue to improve the business environment for these companies, the things like the labor laws that continue to reduce formal sector employment. 1 out of 9 employees in companies of 50 or more employees remains outside the books, according to some of the data. And in addition to that, the cost of electricity, the 75% higher cost, all of those factors are reducing Mexican competitiveness, and I think there are more things to make it more likely for the modern sector to expand and grow faster.
Mexico is not a BRIC country, and that's good, in the sense that it's above that category of countries that are expected to be growing very fast and achieve a lot of things in a very short period of time. Why? Because it's already above that threshold, right? It's a higher per capita income country that has achieved a lot of things. The topic of Mexico moment has been floating on the market for a long time now. Now, I was reading the article for a report that my former colleagues at the IMF wrote last year, and I was impressed by the introduction because it was talking about the macro context of Mexico. Now every Article 4 has 2 paragraphs at the beginning that give you the background. And when you go down the list of things, it is a very good picture from a macro standpoint. So you have low inflation, you have a stable fiscal situation, low debt, a current account situation that is reasonably balanced, a credible inflation targeting regime with an independent central bank, and remember, inflation target at 3 not at 6 or 7 that you see in other places. You have a robust fiscal framework that has been upgraded and reinforced recently. You have a flexible exchange rate, which is fully convertible, and there are no capital controls. In fact, it's the most liquid emerging market currency that you have out there, if you still want to consider the Mexican peso as an emerging market currency. You have a very well-capitalized and profitable banking sector. In case you don't know, the capital ratio of Mexican banks is around 15, 16%, and the profitability return on equity is over 20%. This is a very strong financial sector that they have. And you have competitive exports highly integrated into the US. Essentially, from a market standpoint, you buy Mexican bonds is buying US bonds with a spread, which is quite convenient, frankly. You are going to have reforms and you are going to be overwhelmed by capital inflows. When they come, please don't try to manage the exchange rate. That's my advice. A strong exchange rate will force the churn, will force the creative distraction in the corporate sector. If you want to put it this way, you may become German, and that's not necessarily bad. We have seen the negative impact of capital controls. You have a good macro framework. Don't create a situation where capital controls give you, let's call it moral hazard, to weaken your macro framework, because that would be a pity.
What matters, I argue, is the type of firm more than the size of firm, because in Mexico, as opposed to France, the examples that were given by Angel, the regulation on taxes and the regulation on social insurance is not by size of firm, but by type of firm. And this is very important. Labor contracts are regulated very, very differently. A firm that hires wage workers is subject to a whole bunch of regulations on social insurance and the labor law with respect to severance pay, hiring and firing. And if exactly the same firm was organized as a firm with non-wage contracts, the regulations that would apply to that firm would be different. When you do that, the regulatory burden on the firm changes in a dramatic way, from social insurance, from labor, and from many other dimensions. So it's the regulation on the size, on the type of firms that really matters.
Most of what I'm going to talk about today is going to be based on a recent Peterson policy brief with Ted Moran, the U.S. manufacturing base, 4 signs of strength. So in that policy brief, we look at trends in U.S. manufacturing in general and then link them to total global expansion by U.S. firms. But for today's event, we've done a few updates that are Mexico-specific, where we're going to be looking specifically at U.S. firms that invest in Mexico and what that means for their domestic operations. So one of the key questions here is whether these global operations of U.S. firms in the U.S. and in Mexico or other countries are primarily complementary to each other or whether they primarily substitute for each other. So you can imagine at least 3 different scenarios. So the first one is what Perot and Kerry and Obama and a number of others have in mind when they're fearing for U.S. jobs. This is kind of the zero-sum game mindset that U.S. firms have some fixed number of jobs, and they can fill those with workers in the U.S., or they can fill those with workers in other countries. And in this case, there's just pure substitution, and that's where these motivations for shutting down foreign direct investment or reducing it come from. It's also possible that these 2 things don't affect each other, that firms perfectly segment their global markets. That's unlikely to be the case with the global economy and vertically integrated supply chains, but it's a possibility. And then finally, case 3 is the case of complementarities. And this is the case where firms are strategic in their global operations, and there's reasons that they're opening these affiliates or these plants abroad other than just low wages or purely shifting operations from one place to another. So in this case, there's productivity benefits, perhaps entry opportunities in new markets, new sales, way to capture global market share, and so forth. And in this case, this global expansion actually helps firms to become more productive, more competitive, and hire more workers, both domestically and internationally. And this example would be examples of complementarities. So just to ruin the punchline here, what we find is that case 3 is what dominates. And that if you look at foreign sales, foreign employment, or foreign investment by US firms, that these tend to complement the operations of these firms domestically.
As I've said many times from the stage in just the year and a half I've been president, Gary Huffbauer is a national treasure, and I'm very glad we have him. We challenged Gary and some of our brightest young people, of whom some of you have seen Kathleen speak from here before, and Tyler, to go back through some of the exaggerations and myths about NAFTA and not try to make exaggerated claims for the positive, but give an honest assessment, a genuine empirical assessment of what really happened. And they come out in much the same place on a broader set of issues the way Lindsay does, which is you look at the data and it's not just theory that tells you that trade is good, it's practice and reality.
In this policy brief, we deal with 4 issues which have been very prominent in the criticism of NAFTA over the last couple of decades. The ones that we regard as the misleading charges. There is another charge about growth in Mexico, which we deal with, and that's already been discussed very ably by Yana, but it is in our policy brief as well. We do not regard that as a misleading charge. The Mexican growth has been disappointing, as already discussed. Just to run over them, you can see it there. It's the agricultural export story. I'm going to discuss that. That's the easiest one to rebut, I think, intellectually and with diagrams. Then we have the growing trade deficit argument. That is, the NAFTA's fostered the growing U.S. trade deficit, or the very high level of the U.S. trade deficit. Then we have the unemployment story, which Lindsay's work, which came out after our policy brief was completed, pretty well refutes that, but we go into some other statistics on that one. And then the wages story, which is very coupled with the unemployment story, but is intellectually distinct from it.
You'd see that the Pacific Alliance membership, which has already been mentioned as Chile, Colombia, Mexico, Peru, and now Costa Rica, is in the process of joining in, are knitting together pre-existing trade arrangements in a deepening integration arrangement. If we look at the Pacific Alliance, this is a relatively significant chunk of Latin America. So the Pacific Alliance represents over 40% of Latin America's GDP. It represents about 37% of the population. In terms of the share in world trade, that should be 6.8%. And then in terms of 68% of Latin America's share of world trade. So it's overstated its role in world trade relative to the other indicators, and represents about 40% of FDI inflows into Latin America. So it's a relatively big deal. It's also a big deal because of the signals that it sends in terms of Latin America trade. For Mexico, these are countries with which it already has free trade agreements. These countries all have free trade agreements with one another. They also all have free trade agreements with the US and with Canada. And so even though NAFTA is not a member of the Pacific Alliance, both NAFTA partners are observers in the Pacific Alliance, and NAFTA is there in terms of the joint free trade agreements, and the US free trade agreements are all based on NAFTA and evolving NAFTA disciplines. Now, an interesting element of the Pacific Alliance also is the attention that it has gained. If you follow these things, which probably in this audience more of you do than in the general population, but the Pacific Alliance is the next big thing. there's been an awful lot of press attention paid to this because this is a show of Latin America actually moving forward, increasing its liberalization, showing signs of wanting to go forward. All of these countries are countries that were pro-progress in the free trade area of the Americas negotiations. Chile, Mexico, and Peru are also TPP negotiating parties. Colombia and Costa Rica, by virtue of the fact that they are not yet APEC members, are not, but there is a common base in terms of relationship with Asia and the Pacific. All of them also have increasing trade agreements and bilateral investment treaties with countries in the Asia-Pacific region.
The first thing to emphasize is that the TPP is important for the NAFTA countries, and the NAFTA countries are a critical part of the TPP. TPP represents almost 40% of global output and 25% of global exports, and of that, the NAFTA is really the core of the economic core of the TPP countries. Even with Japan in the deal, 68% of the combined output and almost 60% of the population of the 12 participants in TPP are the NAFTA countries. So that's important. It's important that they are working together to help develop the 21st century rule book that's been talked about. It's important for each of the countries because it adds new FTA partners. But importantly, it also updates existing pacts with other TPP countries. One often finds too casual a discussion of trade agreements as if they're all the same. But actually, the old trade agreements are actually much less comprehensive, with many more exceptions, and with the lack of coverage of some of the new trading rules that are critically important for the conduct of international commerce in the 21st century. And so that is something that TPP is trying to build in and would be incorporated into the NAFTA. When you think about the TPP, often the arguments are really understressed that these agreements have great strategic importance. And that's one area when one is talking about the value of NAFTA or the value of TPP for the participating countries. It is deepening the ties, both economic and political, between the partner countries, makes it easier to manage frictions that inevitably arise in international relations.
We've talked about the development of Mexico's economy with active participation from our friends at McKinsey Global Institute and our friends from the Mexican private sector, and come to the conclusion that there's a long way to go with formalization of the Mexican economy and that is a key part of its future development, but that the traded sector has advanced hugely, and it has not come in any way at the expense of the backward sector in Mexico, if I can put it that way. We have also discussed, thanks to Lindsay Odensky and Ted Moran's work for the Institute, the direct impact of NAFTA on the manufacturing sector in the US, and we've shown, or she has shown, that the investments abroad by US multinationals, specifically in Mexico, just like in their general data set, actually create jobs and income, and in particular R&D investment at home, as well as demand for other services, such that you're getting, I believe you said it was close to 2 jobs generated in the US for every 1 job put into Mexico. And we had a very interesting discussion about the ways we might extend that work, test that work, but the results are very robust. We had a luncheon discussion in which Gary Huffbauer and co-authors put out a very measured, I think, statement that you cannot claim huge transformative gains for NAFTA, but all of the exaggerated claims about NAFTA's ills for the US and for Mexico really are exaggerated and should not be taken seriously. And we had a very fruitful discussion there, including with Doug from USTR, who emphasized the need to, nowadays in the US context, sell NAFTA, but sell upgrading NAFTA and counter the negative aspects in today's politics in the US. We also had a very useful contributions from our colleague Jose de Gregorio from a Chilean perspective on how Mexico has not done that great, could do better, but it's very difficult to imagine Mexico absent NAFTA. And from our academic colleague, Raymond Robertson, of course, is very involved with the labor issues, about the need for greater, more generosity of adjustment in the US process, even though the wage effects, and particularly interestingly, had some new results on inequality in Mexico, going in a positive direction rather than a negative direction in light of NAFTA. And then finally, my colleagues Fred Bergston, Barbara Kochwar, and Jeff Schott tried to turn us towards the future, what the Pacific Alliance has been doing, not just in the World Cup, but in the world, and feeding into the Trans-Pacific Partnership. And Jeff Schott talking in very practical terms about how we can make this, not that NAFTA needs fixing, but how we can build on NAFTA for the Trans-Pacific Partnership. That is where we've been. But I asked you two very distinguished leaders to join us today to give us a little more of where you see the vision statement. Where should we think about US-Mexico economic integration going forward? Where should we think about that in our country's trade agenda? And how can we grapple with the kinds of suspicions that so many in the US public debate seem to have, even if we think, and I think I speak fairly for all of us, that a lot of those suspicions are unjustified.
And finally, to me, the theme of this conference really is something that President Clinton, I think, captured pretty well when he looked at trade issues as a Democratic candidate in 1991 and 1992. I think it's pretty interesting when Governor Clinton gave his major speech on trade, he was 45 minutes late getting off the airplane, which was a harbinger of things to come in terms of his timeliness. But it was because he rewrote with great, in a specific manner, great preciseness, how he wanted to couch his stance on trade. And I think what he concluded was exactly what this institute has advocated in such a serious, depthful, and thoughtful manner. It is reality in terms of trade in goods and capital and services moving. It does cause some dislocation and unease and anxiety in all countries. But the challenge is to harness that inevitability and make it work for people in terms of lifting their lives and lifting their standard of living. And that's really the essence, I think, of trade agreements and the essence of the NAFTA in a very specific manner, and more broadly, particularly from Mexico's standpoint, and from the North American platform that I think is the real future in terms of building on the NAFTA, and hopefully that will be strengthened by the passage of the TPP.
We do not understand each other enough. And we do not actually make our assessments